Hello and welcome to another free No BS Forex, that's No Better System Forex market overview video. This is Mark. It is December 15th, 2013, and today we're going to look at identifying the trend, Elliott wave analysis, and then a section on divergence, how to accurately find divergence. We find this video helpful. Again, this is something we send out every week to give you an idea of what we're looking at for the week, and we typically then will send out a midweek update, which you'll start seeing those up here on the No BS Forex subscription videos. So enjoy, take notes, feel free to watch it over and over, and let me know in the comments if you have any questions, and you can also email me at mark@nobsforex.com. Thank you. Hello and welcome to December 15th, 2013 Quantum Forex Market Overview. Again, majors, Pound USD, Euro USD on top, US Swiss, and US Yen on the bottom. Last week, market review, these were quite a bit out of whack. Still somewhat so, and again, attribute that to a December is probably one of the, at least the last half, one of the worst months to trade as far as volatility and lack of professional traders in the market to set the patterns the way that we like to see them, and that can be seen by the charts how they are. So we expect a lot of consolidation during December. Between now, December 15th, and January 5th is a good time not to trade unless you see some really clear longer term patterns that you want to participate in, and so far we haven't, in my opinion, we haven't engaged on that. I expected to get into some of these patterns at the beginning of last week, so they still might set up for this week, and we'll take a look at those. Let's start with, I guess we'll start with the Swiss, my least favorite. It tends to kind of do its own thing relative to the other currencies. We have on the weekly, we've clearly broken some support levels and seem to be continuing down. We broke the 100% retracement here, and we've broken the previous support over here. Seems to have found resistance, and so it's quite possible that's just going to keep heading down. And it's also quite possible and likely the US yen is going to continue up for a while, which I'll show you. So look for a continual divergence between those two, but we could see this all the way easily come down to a 78 or an 88% retrace at the minimum. So that could have quite a bit to go. I'd expect a minimum of a 61.8 on this drop. But again, December, something that is this unclear, definitely you want to stay out of that. The other currencies aren't as unclear according to our overall pattern. So I'm going to take you to the US yen, back to our weekly pattern, and I've gone ahead and outlined for you the Elliott waves here. Wave 1, 2, 3, wave 4. Nice symmetrical triangle for wave 4. That was a really nice predictive setup for us, and we've blasted out of that. We've put in a spinning top right here at the double top 100%, and not too unlikely then to expect that to drop back and to our trend line, which I've gone ahead and drawn the trend line for you, and I'm going to zoom this out a bit and show you the expected take profit. Now what we did to get that is simply by taking our Fibonacci tool from the top of what we're calling wave 3 to the beginning of wave 3, and expecting that the 127 to 138% would offer the most, the first real resistance zone Fibonacci level wise. Now let's go out to the monthly and see how that lines up with support and resistance. Here we have a support. If you take out all these wicks, you find the resistance. This line is really just at those bodies, and then another resistance, another support over here, another resistance level. So that would be a very logical resistance level at the 127% extension, which would give us 5 waves up, and what we look for then is 3 waves back and then a continuation up again. but that's on the monthly, so that's years out. So we've got a pretty good roadmap for the US yen, and if we take in consideration the Bank of Japan's determination to continue devaluing the yen, that'll give us an insight that indeed this impulse leg, we would look for simply a correction after this, and possibly even a shallow correction, maybe not a retrace all the way back down into 78-88% retraces, but maybe even a 38-50 or a 61 ABC corrective, and then another 5 waves up. So that would go along with the strong fundamentals that we're seeing, strong bearish fundamentals for the yen, bullish for the US yen. So with that in mind, let's go back down to the 1 hour and see what we're seeing here as far as current pattern. You can see we have a wave 1, 2, 3, 4, and 5. So the rule of thumb that we like to teach at Quantum Forex is when Elliott wave is present, trade it. If it's not, don't try to push it. Don't try to make something an Elliott wave pattern that's not. At some level, Elliott wave is always there, because what Elliott wave takes into account is trend and consolidation periods. It's most easily spotted in a trending period. For an example, we're trending down on the hourly right now with a wave 1, 2, 3, 4, 5. Pretty clear and obvious. When you start going into this kind of a phase where it's consolidating, not so obvious. If you're in the midst of one of these areas here, or this sideways action here, it's not so obvious because it's not trending, so we call that consolidation phase. And then the challenge is that a wave 2, wave 4, or a wave B? Because wave 2, 4, and B are the consolidation phases. 1, 3, and 5, and wave C are the impulse phases. So C wave is an impulse of the corrective ABC. A wave is an impulse. I guess I forgot to mention that. A wave is an impulse, and C wave is an impulse, and B wave is the corrective. However, the entire ABC is a corrective. Well, what that does is bring us into this possible pattern, is that this very possibly could be an A wave impulse. And impulse waves have 5 waves typically, and corrective waves have 3 waves typically. However, in the case of this weekly pattern, this is a corrective 4 wave, but it has 5 waves. We come down wave 1, 2, 3, 4, and 5, and then we move out. And so this is wave A, B, C, D, E, and then we move out. So this is a wave 4 with 5 actual corrective waves because it's a triangle. But if you just have a retrace of a zigzag, you'll have 3 corrective waves, and wave A and C are impulse, and wave B is a consolidation phase, or that's a rest in the market. Okay, so going back to the US yen and looking at the 1 hour, we can see that these impulse legs are in place. Okay, here's corrective consolidation, and what we look for then is quite possibly this is wave A. We're looking for a B wave corrective and a C wave drop. We can pull in Fibonacci levels, and it's very, very rare for an impulse A leg to hit the 88%. Typically 61 to 78 are its extremes, and it has to hit at least 38% or it's invalidated as an A leg. So what we're seeing here is approaching the 78. What that tells us is the 78% could be a good place to take a trade. Look for a qualified trade setup, however you qualify a trade. And if we look back, we can see some nice resistance levels and consolidation. This kind of dissects this whole consolidation right in here. And so we would say that if we hit that, now let's drop down to the 15-minute chart and see what's happening. Very clear 5 waves. Definitely looking for an ABC corrective. Now there's a very, very easy way to play this, and very safe. It's called a 1-2-3 setup. And for those of you in our intermediate course, that's what our main system we teach there is a 1-2-3 setup. Now it's a lot more to this than what I'm just going to show you, but If we move up, if we hit this 78% and move up and break this trend line, it has to be a significant break, not just a few pips. And then we move back down to not break the low, but come back anywhere from a 50% to 100% retrace, somewhere in there, after breaking that trend line. And quite often that will come back and actually touch on that trend line, and we call that a trend line break, where it was resistance, now it becomes support. And when you start to move that other direction, quite often with a rejection candle, prime opportunity to get in on that and ride that up, because we're calling this an A wave. It clearly is an impulse, 5-wave impulse. No guarantee it'll end here, could end where it's at right now, but then let me pull out to the 4-hour. But then we would hope to see this, or expect to see this, move up as in a C wave. So you would actually grab the 1, 2, 3 setups is grabbing the C wave impulse and riding that up, and then knowing Fibonacci levels, projection levels, where to take your profit. And in this case, then this would then be another 1, 2, 3 point setup, this being A wave, this being B wave, where down here you had A wave and B wave. So what I teach in my classes, intermediate and advanced courses, is to combine Elliott wave patterns, combine overlapping wave patterns. So in other words, wave A and B, but also understanding then that wave A has 5 waves, wave B has, and ABC would have 3 waves, and then you can trade the C wave of that B wave. And if that sounds confusing to you, I totally understand. Stick around for these other courses that we put out for free, and you'll catch on to some of that. But suffice it to say that we have this impulse. There's an opportunity to scalp on the way up on the C wave, and then of course there's the opportunity to grab this completed B and grab a C wave down, possibly a projection all the way down to this trend line. If you miss all of that activity in there, fine. Look for, bottom line, look for a bullish move around this trend line, which we would have expected a blast out, and then a 1, 2, 3 wave 4 retrace down somewhere approximately 61.8% total retrace, down into this area, about right so, top of wave 1, and retrace down somewhere in between the 61.8 and the 50 would be right around that trend line. Look for rejection candle, and you want to buy that. So because we've got some pretty firm direction, meaning that we're looking for this impulse up into this area, there's a lot of opportunity to play directional on the 15-minute and the 1 hour down towards trend line dips, and keep buying off the trend line up to this area, but also look for smaller completion cycles and wave 5 exhaustions, and then trade the ABC corrective down. Okay, let's go to something that's a little bit more simple. That was a little bit more on the advanced side of things. Let's look at the pound. Nice setup here. I want to look at what we call market flow, or trend, the trend technology of identifying trends, and it's really very important to identify where you're at in a trend and consolidation phase. Elliott wave is real. It works all the time. It's just a matter of identifying it, and when the Elliott wave is clear, you want to trade it. But within understanding Elliott wave, you understand trends and consolidations, and that's what the waves are made of. Wave 1, 3, and 5 are trending waves. 2 and 4 are consolidation waves. Wave C is also trending. But what we see here is a nice move down, and we need to deal with higher lows, lower highs. So as we've continued moving up, we had higher high, higher high, higher high, and we've hit this peak, the highest high. And as we do, we have a higher low, and a trend consists of higher highs and higher lows for a bullish, lower highs and lower lows for a bearish. And what we're getting here is we've actually hit a highest high, retraced, and moved higher. So this has become our higher low right in here. And if you want to really, the best way to do it is find the support level. The wicks in these cases isn't that big a deal, but we've clearly broken the higher low. What that means is our trend up is over, and we're now bearish on our 4-hour. This is the pound USD. So in the 4-hour we are bearish. Okay, what we like to see is this break of the higher low and then a retrace back up to give us a better position. And like I just described, that's a 1 point, 2 point, 3 point setup. We call that a 1, 2, 3. Some people call it an ABC setup. Basically what it's giving you is a zigzag, A, B, and then you're trading wave C. Could turn into a 5-wave impulse down, we don't know. But all we know is that when we break this higher low and the trend then shifts from bullish to bearish, we don't want to get in right away, because otherwise you move down and you get in bearish and then it bounces up. Why? Because it didn't take out the higher low. Starts down, you get in bearish, bounces up. Negative, negative, negative. It didn't take out the higher low. This trend is still ascending. You'll notice though, most of the time, very rarely does it take out a significant higher low in a significant manner and then continue up. Why? Because the trend has turned bearish. What you want to look for then is that 80% of the time, 20% of the time it'll just keep going and it won't come back. Forget about those trades. 80% of the time it's going to break, in this case, a higher low. It's opposite if you're trending bearish and you're trying to get in. But it breaks that higher low, and then it'll retrace back up into some resistance area, some Fibonacci level, usually 50 to 88%, a retrace of the initial impulse down. It'll retrace usually at least 50%, and that's a very good opportunity to get in. Instead of trying to get in here and losing all of these pips, you can get in part way up here somewhere. Stops go above the high, and then you've just positioned yourself with a fairly good risk-reward ratio. And if we look onto the daily, and the reason I'm showing you that good risk-reward ratio is we're going to come all the way out to the monthly. I'm going to show you a pattern, and this is a triangle pattern. What it looks like we have is wave 1, 2, 3. It appears we're in a wave 4 consolidation here, and we've moved up and it looks like what we have is wave A. So what I'm going to describe to you here is an ABC. Typically these patterns show up in a B wave. Okay, so it looks like we've impulsed up wave A, and then we've retraced in 5 waves. It's coming into a symmetrical triangle. A, B, C, D. Symmetrical triangles have 5 waves always. Triangles don't necessarily have to have 5 waves, but symmetrical triangles do, and this is a pretty symmetrical triangle, meaning it's going sideways. It's not going down against a support level. That would be a descending triangle. This is pretty clearly a symmetrical triangle. Impulse up, very clear impulse, and all of these look like they're consolidation, because that's what happens, 5 waves of consolidation. So you have A, B, C, D, and then we're expecting this E wave down, and that's over 1,000. Actually, that's depending on the angle. Extreme angle would be like here, but still that's over 1,000 pips. So when I said better leverage, if you could get in, even catch 700 of those pips, and you can get in this break here, and you can see on the monthly we're right on the monthly at the top of this resistance level. Now what we'd expect after that, seeing that this would be A wave, B wave, then we expect this C wave to move up anywhere from a full 61.8% retrace to the bottom of this wave 1. So then we're going to want to get bullish. We're expecting at that point the pound to gain in value and the dollar to begin losing value. Okay, if and when that happens in the US yen, the yen is still losing value against the dollar, we're going to have a great opportunity on the pound yen. That's months, if not a year away. This move up took 1, 2, 3, 4, 5, 6 months, but look how long the move down took. That's probably a year and a half, 2 years. Something like that. This was about a year moving up. So this could easily be a year away before we start seeing a major burn on the dollar and the pound gaining strength against the dollar. So a lot can change in then, but suffice to say, you can see how long this move up would be. Typically, you can expect a C wave to be at least as long as A wave. A wave being this long, C wave starting somewhere in here. You can see how that comes up near the bottom of wave 2. And I would like to see a 61.8% retrace. Those are nice for wave 4s, but this, if it's the same length as wave A, you can see that it would pierce that, and actually wave C is at least as long as wave A, and many times it's longer. So this is just a very rough projection, but that's what we're kind of looking for. So what I'm giving you right now is really projections into next year that you can't take these to the bank, obviously, but there's something to begin to gauge your qualifying entries off of, and smaller time frame projections. This isn't something that I've made up. Clearly, this is Elliott wave analysis. This is triangle analysis. I mean, this is just the fundamentals of how the market works. Does it always happen the way we expect? No, but really 80% of the time you can count on these kind of patterns, and they might not be exact. This could burst up a little farther and then put in a big wick rejection and then move down, or we could pierce even below this a little bit and then move back up. But generally speaking, these patterns do play out a good 80% of the time, and you can start to find you can use them as a framework to find smaller time frame patterns, and as long as you're qualifying off of some precision qualifications, you'd be just fine with this kind of analysis. And this is one of the qualifications. Instead of just taking a short because we're in that area, let's wait for the momentum to change and the trend to change on the 4 hour. So we're bearish on the 4 hour. Let's get that retrace with a 1, 2, 3 setup. Let's use some some momentum oscillator, maybe some stochastics on the lower time frame. Let's look for some rejection candles and then get in short. So I'm not interested in trading the pound USD at all until we get up into this area. Might not even get there this week or next week. It might be January, but it's possible we could get there by Monday or Tuesday also. So we'll keep an eye on that. Okay, the last and not least is the Euro USD in a very similar position. Here's the 4 hour. We've moved down, broken the higher low, put in a highest high, broke the higher low. We're clearly bearish on the 4 hour. Let's go out to the monthly. We're in kind of a similar triangle position on the monthly. I'm not going to get into the analysis on that. What's more important to me right now is the weekly, where we're double topping. And I've talked about the fact we have some more movement up into some resistance up in here that I could see happening, and even farther on this monthly to come up even higher. But what I'm really looking at this point is where we're at on this 4 hour. We've changed because we've changed directions, and we're now bearish on the 4 hour. So regardless of the longer term on this one, which the longer term looks bearish on the pound, and so typically it follows you're going to be bearish on the euro, but of course not always. And if we're not, and we're bullish on the euro and we're bearish on the pound, then the euro pound could be a good currency pair, cross pair to trade, and go ahead and go long on the euro pound if these currencies diverge with each other, the euro and the pound. So again, we're looking for the same thing. Let's drop down to hourly. This one is pretty clear. A, B, a little more clear, kind of like the US yen was clear with 5 waves. Wave 1, 2, 3, 4, 5. So wave A, impulse, and we've already moved up, retraced, and it appears we're impulsing. Wave C is our impulse. So what I'm looking for here is very simply, if we moved into a 38%, which you intermediate students with the 1, 2, 3 setups, you know that's a minimum we need to qualify for this initial A wave retrace. So I'm looking for a 78 to 88% retrace here. Now, what I would like to know is, do we have divergence on the 4 hour at the top here? So I'm going to bring in another tool. Go to my oscillator section under the, and go to momentum. I like to use a 10 momentum. And I want to see if we have divergence. Now here's how we do divergence. Very easy. Go to your highest point, vertical line, and then go back to the highest point on your momentum oscillator. Oops. So I want to know between this point and this point. I went to the highest point on my candles, and then I went to the previous highest point on my momentum oscillator. What I want to know is between those 2 points, do I have divergence? My momentum oscillator clearly is going down, and my my candles are clearly going up between these 2 vertical lines. Clearly I have divergence. There's no ifs, ands, or buts about that. There's no question about that. We've made it very mechanical, very precise. It's extremely clear we have divergence. Okay, what that tells me is with divergence and my trend turning bearish within 1 through 5 impulse, and then a pretty clear ABC forming, this 78 to 88%, if it gets hit, that is a tremendous predictive zone for a short. Now I can go down to the 5-minute after that happens, and I can, when I get anywhere into this area, be wonderful if I get a rejection candle on the hourly or at least the 15-minute. But even if I don't, I can go in and look and see on the 5-minute or the 15-minute, because this is an hourly chart. So I drop down a little lower once I get up into this area. Do I have divergence on the 5-minute? Just like I demonstrated here. You can do the same exact process to get your divergence. If I do, and then the momentum, and the trend goes from being bullish on the 5-minute, and I break a higher low and retrace on my 5-minute, and now I'm bearish on my 5-minute, and I'm also in a 1, 2, 3 setup zone on my 4-hour, I can actually enter a trade on the 5-minute chart in the direction of the 4-hour bearish trend after a retrace. That gives me tremendous risk-reward ratio, and look where I'm headed overall. I can actually be in the direction of a daily trend, because see, the daily's broken too. Here was the higher low, here's our highest high, impulse move down. We're now, until we break this high, we are bearish on the daily. Well, where would that put us? Our Fibonacci extension is down the 127, 138% zone, which is also a support level. Wow, that's quite a drop to get in on a 5-minute chart. And if we do that, that would be 680 pips. Let's just call it 600 pips. What if we can get in with a 50 pip stop loss because we're dealing the 5-minute chart? That's a 1 to 12 risk reward ratio. Even if we didn't get on the 5-minute, but we actually, you can see my little dot there. Even if I went to the very top above both of this double top, that's still only going to be 50 plus pips. So I could even, on the 5-minute, it might only be a 10 or 15 pip stop loss. Well, you get a 10 pip stop loss, you get a 600 pip drop. That's a 1 to 36 risk reward. That's huge, obviously. Now, even if you can get a 1 to 100, a 100 pip stop loss, that's a 1 to 6. That's well within our range. We like to be at least 1 to 3. Now, that takes a little bit of skill, patience, time, emotional control to be able to get in with on a 5-minute. But some people have that, and some people are developing it, some people don't. But regardless, you can still have a great opportunity on this. If you were getting in at this point, set your stops up above your previous high. You've got a 50 pip stop loss, and you've got a 1 to 12 risk reward ratio if you rode that out. So just some ideas and some techniques might be able to help you out. And that pretty much wraps up the market overview. If you have any questions, don't hesitate to email me, mark@quantumforex.com, QUANTUM. I'll actually, number 4, letter X.com. I'll put it on the screen for you there too. And that'll be it. And God bless you. Have a great Christmas, New Year's, and we'll keep you updated as we see things move.